Okay, we're back, folks, and I believe we have Jeff Hughes of Alpha Insights on the line. Jeff, are you there?
I am. Good morning.
Yes, good morning to you, my friend. Could we start out with your short-term view of what's going to happen? You've got the cash S&P thing up there to tell the folks what you're looking at.
Sure, Larry. And first of all, thanks for having me on the show.
Oh, it's a real pleasure. We have Rich Anderson on the line, and Rich thinks you're about as good as it gets with this stuff, so we'd like to hear what you have to say.
Well, I appreciate that. In a short-term view, basically, we're looking for the market to peak, around the levels that we traded to yesterday. So we've been kind of calling for, this kind of counter trend move. We think the market topped on September 2nd. Which is very, very interesting because September 2nd was the anniversary date of the crash of 29. The 1929 roaring 20s bull market actually peaked on September 3rd, 1929. The Dow actually peaked on the 3rd this year, but the S&P on the 2nd. W.D. Gann was very observational when he pointed to the idea that anniversary dates matter. He said, the market never forgets and that these dates are important. And, he spent a lot of time kind of figuring out how to balance time and price by identifying these equilibrium points where he combined geometric angles and anniversary dates of past market highs and lows of great significance. And, very few highs are more significant than the crash of 29. And so I thought that was an interesting and really apt point for the market to top. It also happened to be almost exactly 90 years. 29, 2000 is actually 91 years. But the Gann cycle, which is kind of a 30-year, 60-year, 90-year, you've got these varying harmonics, which are just multiples of that 30-year span that kind of create these longer-term market cycles. And Gann always gave them plus or minus a year. So 91 years is right in there. And to top on September 2nd, I thought was apt. We've also counted 5 waves down since that top into the September 24th low. And so what we've seen since then is what right now counts as 3 waves up and about a 61.8% retracement, which is pretty typical of what the market would tend to give. So, we're looking for the market to decline, and we're looking for a hard down move. We think the first evidence of that will be, a break of 3,300. And then we think taking out the September 24th lows will kind of seal the deal. There's actually 6 gaps that remain unfilled. And these are very sizable gaps going back to actually the low on March 23rd of this year. And if we think about, those gaps, we're not going to advance to significant new highs without filling those gaps. They will be filled, and we think that this is the preliminary move before we see the decline into those lows, which kind of takes us to our intermediate term view.
Okay, let me get this up here so the folks can see it. We have a question, Jeff. Is there any significance to the fact that the Dow Jones Transportations made new highs yesterday?
Yeah, we did a deep dive study. Well, we did a deep dive study on the transport index. And, I think one of the reasons that the transports have moved the way they have is because it's a price-weighted index. And we had companies like FedEx and UPS, which are very high dollar price stocks, kind of driving that index to the highs. But we've also seen, a wide variety of stocks, kind of the commercial air carriers, for example, and some of the travel stocks have utterly collapsed. So you've got a huge bifurcation between kind of the logistics and delivery companies versus the commercial air carriers. But right in the middle are the land-based rails. And so, we believe that the best place to be within the transportations would be the rails. We think they have upside, but we think that the package delivery and logistics companies are peaking or have peaked in many cases. We've already seen some rolling over. And we think that the commercial air carriers and travel companies are basically dead and left for dead. We don't think any bailout that the government throws at them is going to do anything more than keep people who work there employed another 3 to 6 months before they have to do it all over again. It's just throwing good money after bad as far as we're concerned.
Well, that's really a good point. I didn't realize that the Dow Transports was price weighted, and just two stocks could make that thing go crazy because we can see, what's happened with the NASDAQ. Really good.
Yeah.
Now, your long-term view, Jeff, is really quite bearish, isn't it?
It is. And in fact, we'll talk about the intermediate term view, which is the chart you have up there now. That's really the last 11 and a half years. And if you take a look at that last little leg from, 0.4 to 0.5, that's what we were just looking at. That's the short-term view. So if we go back all the way to March 2009, you can see how this bull market progressed over the last 11 and a half years. And it did so at 5 waves up, if you will. And those 5 waves subdivided into 5 waves, which subdivided into 5 waves, which is basically the fractal nature of the markets and of the wave principle. And we're big practitioners of Elliott wave principle. We've studied it for over 20 years. And we're confident that our count is an accurate count. What happens is when you get into these final, wave moves where there are a lot of subdivisions. And so what you're just waiting, you're waiting to see how the market subdivides out. But it's I don't want to say it's preordained because anything can happen. We do have a bullish alternate view, which could take the market to, say, 3,900 to 4,000. But that's a low probability view. It would require the market to make a new high even for us to entertain it. And at this point, we think the highest odds favor an immediate decline that fill all of the gaps down to the March 23rd low and continue lower for what I would define as a 61.8% retracement of the intermediate term cycle wave 5, which you're looking at in this chart right now. And that would take us down to about 1,780 to 1,785 level in order to hit that retracement. And we would consider that to be primary wave, cycle wave A of a 3-wave move that's going to correct a much, much larger bull market advance, which dates back 120 years.
Wow, that's really great information. Holy cow. Jeff, we have a question for one of our listeners, and that is you've posted these charts and you've looked at some Fibonacci levels. What piqued your interest in Fibonacci? Was it the Elliott wave?
Yeah, I've studied Elliott wave for over 20 years, and understanding the mathematical relationship of these waves and how they work relative to nature and human social behavior coincides and dovetails very well with Leonardo Fibonacci's mathematical sequence, which is found, repetitively in nature as well. These ratios of,
Okay, Jeff,
sounds like you got to pay some bills.
We have to pay a few bills here, so stay with us. We'll be right back, okay, folks? Jeff Hughes, Alpha Insights. We'll be right back. Okay, we're back, folks. We're talking with Jeff Hughes of Alpha Insights. And Jeff, I would like to switch the subject matter here over to the cycles, because that's one of our favorite things here at TFNN. I've been studying it for a long time. But you want to tell us what you're looking at here with this S&P cycle? Because it's certainly looking like it's fitting quite nicely.
So we borrowed a chart from our friends at Ned Davis Research, who put together this kind of composite of 3 major cycles: the seasonal 1-year cycle, the 4-year presidential cycle, and then also the 10-year decennial cycle. And it's interesting when all 3 of those cycles kind of align, you tend to get a pretty consistent move. Now, one of the things that we'd kind of been identifying, and in that chart, the yellow dashed line represents the market in real time, and the blue line represents the cycle. And so the cycle was a little bit early in terms of peaking and collapsing from February to late March, where in fact it was scheduled to peak in early April and collapse into late May. So it was pulled forward, but we think that the advance brought it back into sync, where the market peaked almost exactly on schedule at the end of August, beginning of September. And so we've been kind of cycling right into that projected low, which basically goes hard down into the November 3rd election. And we've seen a lot of volatility, as all will know, with this, what I would call a counter trend rally into yesterday's highs, and probably that peaked perhaps yesterday or today. And we see something of, a hard decline into the November 3rd low. That cycle should then bottom and turn up. However, there are other cycles out there that continue to point hard down into December, which is interesting because this election, as all, again, will know, is likely to be something of a contested election. Even if it's not a close election, it's likely to be contested because the incumbent president has made it clear that he believes the election is rigged. So if, in fact, it is a contested election, it makes sense that the market would not necessarily bottom as this typical historical cycle would suggest, but might have some more nuanced sort of downside potential to it. And if you look on the next chart, we take a look at the Bradley model, which was a kind of a celestial cycle, if you will, developed by Donald Bradley back in the 1950s. And Bradley wrote an interesting pamphlet that kind of described his work. And frankly, a lot of it is based on W.D. Gann's work, which also was based on the lunar cycle and, the harvest, because he was a commodities trader and he was interested in identifying weather patterns and things that influence the weather that would then influence the harvest in various commodities and give him an edge. And so a lot of those cycles really exist because they affect human social behavior, because different orientations of planets and the moon reflect greater solar radiation on the Earth and have an impact on the central nervous system of human beings. And so it affects our behavior and decision-making is the theory. So, based on that theory, one can then presume that, we're in a very high tension situation right now. And the Bradley model confirms that, we're going to see kind of an excess, if you will, of electromagnetic radiation impacting human social behavior into kind of that December 2nd low that the model has identified as the next turn date. And so we think, just kind of looking at whether you buy into, kind of this financial astrology or the lunar cycle. I know Paul McCrae Montgomery had taken it kind of to a new level, applying it to the stock market, and made a great career over 35 or 40 years in the 70s, 80s, and 90s, predicting exact market tops and bottoms using many of the exact same sort of configurations that both Bradley and Gann use. So there's no question that it has it has been validated in terms of its practical use. And so, we just want to be aware of it and kind of overlay these things to our other work. And, our chart work tells us that A, we've broken trend, okay? B, the wave count is set up for a big decline. C, there are many, many open chart gaps that need to be filled. And then we get into kind of what's going on in the world, and we're in a very contentious sort of political environment right now. The cycles are all pointed hard down, and we want to be very cautious, positioned with, excess cash reserves in short-term treasuries. We want to, increase our allocation to safe havens, if you will, and reduce our exposure to risk assets. And within risk assets, we actually consider gold and commodities to be risk assets, not safe havens. And so, we would not be necessarily turning to gold as a place to hide right now. We think it could be influenced by the exact same, kind of cyclical factors that are affecting equities right now. So we would hide in very safe, stable cash reserves and short-term treasuries, for the intermediate term or the immediate future here as we go into this election season and come out of it on the other side. And we'd be looking for the markets to probably put in at least a tradable bottom in late November, early December, as kind of the cycles suggest.
Wow, that's great. You really got this laid out really nicely, and the folks here understand what the Bradley model happens to be, and it's another good guideline that we can use. Jeff, one of your charts here, you're looking at the Treasury notes and Treasury bonds is related to yield, and what we were talking about today before you came on is the fact that they're telling us that rates are going to be going lower, and yet rates have not been going lower over the last couple of weeks. Can I post this chart that you have here of the yields, because it really shows where everything changed. What's your feeling here as far as the notes and bonds?
So a couple of things. First of all, some people might know that I used to work for Steve Leuthold, and Steve Leuthold was, kind of the guru of inflation cycles. He wrote a book on it in the 70s, and, nary a day would go by where I wouldn't hear him espousing some opinion about inflation. So, I became pretty ingrained in my way of thinking how to understand inflation from a monetary perspective rather than a, cost push perspective. And, interest rates are going to have a great bearing on that. We've already heard from the Federal Reserve that they're going to let the economy run hot. They're going to let inflation exceed their target. Well, they haven't been able to do that for 12 years, so I'm not terribly concerned about it. But what I am seeing here is I'm seeing rates bottoming. And one of the models that Leuthold developed many, many years ago was using something that he described as very long-term momentum, or VLT momentum. And it's really just overlaying the Kopic curve developed by Sedge Kopic back in the, I think, in the 40s. And actually, no, I take it back, in the 70s. And Sedge is, he might still be with us. I can't remember if he's still around, but he and Leuthold were buddies. And they used this model to try and identify the turning point. And what we're seeing, and we can talk about this after the break, but the momentum model is beginning to turn up, and that's a clear indicator that price should follow.
Thank you very much. Stay with us, Jeff. We'll be right back. Okay, for back, folks, talking with Jeff Hughes of Alpha Insights. Jeff, I posted the link of how the folks can get in touch with you. And we have a question for one of our listeners. Are you a professional money manager?
Well, I just manage my own money these days. So we've set up a family office, if you will, and we run 3 different hedge fund strategies internally just for our own capital.
Okay, that's very good. Well, this is really interesting. Would you mind coming on in another few weeks to talk to us again? We've had a really good response, and it's the type of thing that the folks here like to see, is the technical part. So maybe towards the end of October, close to the election, we might have you on again?
Well, of course, I would be delighted.
Oh, that's super. Do you, any words of wisdom that you have here the last minute or so that we have?
Well, I would just say just be careful with 10-year Treasury yields. It looks like they have, they could double before they run into any level of serious resistance. Not that I'm predicting that they could double, but, I mean, there's really just nothing holding them down here. And I think if we do see an upturn in this VLT momentum, we'll know at month end. It's a monthly close that hooks up. That would be a good tell that rates are on the rise. And it wouldn't surprise me to see 10-year yields at 1.5%, say 6 months from now. So anything can happen. So that's what I'd be keeping my eye on right now.
Wow, that's interesting. When you said 1.5%, I can remember just like you that it was a standard many years ago that the old folks relied on that 4 and 5% yield on the notes and bonds, and we haven't seen that in a decade. So it's going to be interesting if we ever get back to that level again.
No doubt.
Listen, thanks for joining us today, my friend, and it was really, really good. And just keep safe out there, and I hope you're all right there in Minneapolis, because we talk to Rich all the time, and you never know what's going to happen when you go out in the street. So please be safe.
Likewise, Larry. Thank you very much.
You bet. Okay, folks, that was Jeff Huge of Alpha Insights, and we'll see you tomorrow. Our guest tomorrow will be Bill Chapman of Trend Reaction. We haven't had Bill on for a while, so he'll be chatting with us. We'll be right back tomorrow.